Hello everyone, so today's video we're going to be forecasting a buy, refurbish and refinance property project. So this is the sheet that we use internally and customers and clients of ours use as well to understand really what the figures might be around any property they're looking at if they're doing a buy, refurbish and refinance strategy. Now there's other sheets for other strategies and there'll be links in this training course for those as well. If this is the very first forecasting sheet you've ever looked at, I'd say to go back to the the very first one, which is the buy to let financing sheet. That'll give you some idea in terms of the context of really the foundations of how and why we've kind of put this sheet together, what the columns are used for primarily, and really just give you some background information on it. So we don't have to do that and spend your time every single time on every single video to showcase that. If you go back to the very first buy to let video, that'll show you really how to do that. And then specifically, we can just focus then into the nuances of the columns and the cells and the rows that are specific to each individual strategy. Now, this particular forecasting sheet takes into account lots more information than a straightforward traditional buy-to-let. And that's primarily because there is more information than we need to assess and understand whether a particular given property is going to really work for this model. So you ultimately want to buy a property, buy it at a good value still, refurbish it, add some value there, and then also be able to refinance it. Typically, that strategy is used by investors to pull out all or majority of their original funds so they can then use those funds to go on and invest in future properties. Now this does require leverage. It does require an extra element of kind of risk reward. Obviously there's no free lunch when it comes to leverage. You do kind of create the upside or add to the upside, but you also add to the downside. Obviously if there's a property crash and you've got leverage on those properties, it is something to consider. But specifically with this forecasting sheet, what we want to show you ultimately is how and why using a buy, refurbish, refinance model can work to pull out some of your original capital. So similar to the buy to let forecasting sheet, we've got a couple of different columns here. Primarily we're focusing on the flip aspect, and then we have also the stamp duty land tax aspect as well. Now again, if you've not seen this before, if this is the first time you've seen it, if you go back to the buy to let original kind of video for forecasting, that'll give you some context to what all these figures mean. So flip projects, let's start at the top and work our way down. So we've got the property address here. We've got possible case scenario, which we'd add most of these details in first, and then we can see if the project works or not. If it does, then we can start to look at and assess, right, what does the worst case and best case scenario start to look like. So this particular property, we're going to be assuming a purchase price of £150,000. That gives us a stamp duty payable here of £5,000. That's automated from the stamp duty land tax column. That's made up of both traditional stamp duty payable and also stamp duty premium that's going to be payable as well. Sourcing fees, any sourcing fees that are applicable, legals, auction fees, surveyor's fees and mortgage setup. All of these will combine to give us our total purchasing cost. Now again, anything in the blacked out columns or cells, that you can see here, they will be automated. Anything that's not got a blacked out cell around it, you will be able to tweak those figures to suit your particular deal. So once we've got an idea of our buying costs, both in the purchase price and also the purchasing costs, we can then look at refurbishment. So it's a £150,000 property. We're going to be buying and doing about a £20,000 refurb on this particular sheet. But let's say if we increase that slightly and it becomes a £25,000 refurbishment, you can see how that impacts this total investment cost. You can see how it also impacts the contingency and also impacts the refurbishment management if you are using a project manager on the project. So we're now into this total project for about £183,000, as you can see here. Now, one of the important things to consider is buying, refurbishing, and refinance. It is short-term funding if you are raising leverage to the project that you would need to do that refurbishment stage. Now, when it comes to lending, both from banks if you're looking for a traditional buy-to-let, or banks if you're looking for commercial finance, or even bridging finance, we can certainly give you some context if you need to raise financing on those projects. But you want to make sure you're speaking to a mortgage broker that has experience with this model so they can point you in the right direction of which lenders to use. You don't want to be using a buy-to-let lender that has a long-term plan for their financing of say 25 years, if that's going to mean that you're only going to be in that finance for about 6 months, because you run the risk of really upsetting and annoying lots of different brokers, lots of different lenders, and ultimately putting a bit of a bad mark against your name when it comes to raising finance later on down the line. So you want to do things properly. That is probably going to mean slightly more expensive finance because it is shorter term finance initially, but you want to make sure your deals stack and work with the right assumptions in place. If it doesn't stack or work with that type of finance, then maybe it's not the right type of deal, or maybe you need to buy it slightly better or look for another opportunity. What that means here is that we're going to be looking at a total finance amount. So this takes into account if you're funding the full project. Now, very often that wouldn't be the case. You'd usually be putting some money into the deal. But the reason why we leave this as if we're funding the full project is because very often people miss the opportunity cost of using their funds on something else. So yes, you're going to be putting some money into the deal possibly to either buy the property outright and fund all of this in cash, or you may be putting some money into the deal and using the rest of it as leverage with a bridging loan or commercial finance or private finance or even mainstream mortgage finance if there is a refurbishment kind of product that works for you with that kind of model. But if you're putting money into the deal, you want to make sure that you are accounting for that really from a opportunity cost point of view. And by ignoring that, it really skews the figures. So it's just easier for us to wrap all of the kind of total amount into one simple figure, which is effectively the amount you're totally putting into the deal. Months holding. So this is the length of time that we're assuming the project is going to be before we move on to more mainstream finance. And then the finance rate for this. This is set at a per calendar month cost. So let's put this in here, PCM. Ease of use. So that just gives you a bit of an idea as to where this 1% kind of comes from. Very often, if you're looking for private finance, 1% is about right. There might be more costs associated with that. So you might have an entry fee, an exit fee. Ultimately, it does depend upon who you're going to for the lender. So for example, our latest project, we were looking at about 1% for private finance, but no entry costs, no exit costs. However, for bridging lending, we were looking at a lower amount, probably about 0.85 was the best rate we kind of got for a particular project. But they did have entry fees and exit fees. Now you can go into a lot more nuanced detail. There'll be extra costs associated with it potentially for increased surveys, things like that. But you can always allocate these, I would say, to the more relevant column. So if your legal fees increase, I'd put that there. If your survey fees increase, I'd put that there. If you have a particular entry exit fee with the mortgage setup, I'd put that there, that relevant to your bridging. This specifically, we're just beginning looking at interest and the finance costs. So now what we've got is a total investment amount. Assuming that's all leveraged, even if it's using your own money, you need to allocate something to it. How long the project is going to anticipate taking, and then your rate of interest per month, and that'll give you here your total finance costs. As we move down the sheet, we then start to look at stress calculations. So we've got your total purchase amount, all of these here in the blacked out columns, or cells, as we mentioned, that's all pre-populated. The only thing that is really different here is your resale fees. If you were looking to sell the project for any particular reason, it's important to understand to add those resale fees into the calculation. That gives you a total project cost when it comes to potentially flipping the deal on if you needed that as a plan B. Now, in the previous buy-to-let forecasting sheet, we had a plan A in one tab and a plan B in another tab. In this sheet, we've included it all in one because it makes sense from a sell and forecasting point of view, because everything pretty much is there already in this data. The only thing we need to add really is this resale fee in addition. So just to bring some extra context to that, total buying fees or total buying amounts, you've got purchase costs, purchase price, refurbishment, so your total investment plus your interest for your finance or opportunity cost, if it's your own money, plus your resale fees. That gives you a total project investment here of 197,000. Property sale, this column you can tweak here. So let's say we get 240 for it when we go to sell it. You can see how that impacts this profit on sale and net profit percentage. So that takes into account this figure here, your sale price minus your total investment cost, gives you your profit. So your profit would be 41,000, just under 42,000 on that deal. And your net profit as a percentage would just be over 21%. So hopefully that gives you an idea of what that deal would look like if you were to buy it for about 150, spend about 25 on the refurb, was to sell it for about 240, to give you this sort of profit margins at the back end of it. So that's great. There's a bit of a plan B if you're looking to maybe sell a property. However, if you wanted to buy, refurbish and finance this particular project, it's important to understand what the rental yield is going to be looking like, and also what the value and money left in the deal is going to be looking like. So let's go through these columns now specifically. So new value, we're assuming a new valuation of 240,000. So that's going to be the valuation, let's say, if you were to sell it, and also if a surveyor was to go out and value it post refurbishment, what they think the new valuation should achieve. Refinance. This is going to be different depending on each individual investor. So we've tried to keep it simple and just have it really as a percentage amount. Some investors prefer lower leverage, so they might go 50-60% loan to valuation. Other investors prefer higher leverages. So this takes into account a 75% loan to value, so £180,000 is assuming that if it values at 240, you'd take out 180 on a more mainstream traditional mortgage on the back end when you refinance. Existing finance, so this is your total amount in the deal. You can see here it's £183,500 is how much you put in the deal as total investment costs. Then you had your cost of funds. So if you're buying cash, this is really just an opportunity cost. It's not a physical cost that you're putting into the deal. It's just an opportunity cost. If you're using leverage, even if it's up to 100%, that gives you an idea of what your potential cost of funds might be. Add those two together, you got your total investment. And then that shows you really what you're going to be leaving in the deal when you go to refinance it. So if you were using 100% leverage to do the purchase and the refurbishment, and then you would get a value of 240, and then a value or a mortgage, for 75% loan to valuation at the end, you'd be pulling £180,000 back out of the deal on that new mortgage. That would cover most of your original investment, about £3,000 left in, but it would also cover, or not cover, sorry, you've got your finance costs on top of that, and it gives you an idea of what your total left in deal is going to be looking like. Now, in a best case scenario and a worst case scenario, these figures are going to impact wildly differently, because there's lots of things that will change this potential valuation as you start to assess and go through the particular deal. So let's say on this worst case, we paid a bit more for the deal. And also the refurbishment maybe was slightly more. So let's change this up to 27,500. It's not rapidly higher, just a small amount. But maybe it's a longer project. Something goes wrong or it takes a little bit longer to do. 8 months is probably about right on a worst case scenario. And you can see how these figures start to change. Also, if we only sell it for 220 rather than 240, on our profit, if we were to sell, that's radically reduced. But also the money left in is radically reduced as well, because our end value is lower, the amount of money in the deal is higher, and our loan to value here is slightly lower as well. So we're leaving a lot more money into that project. Now this is very important to consider, because if you're using a buy, refurbish, refinance strategy, and you're ultimately relying on pulling out all of the money every single time on every single deal, it only takes one deal to go slightly off par for you to really be struggling on the deal details. So maybe you don't buy it for the right price, or maybe you don't get the end valuation you need on the day with a surveyor, or maybe there's no mortgages out there that gives you the right loan to valuation here to pull out as much money as you can. You need to give yourself some spread. So if you've got some money to invest in property and you want to do the buy, refurbish and refinance strategy, just make sure you're not putting every single penny into every single deal and needing to pull it all out. Give yourself a little bit of a cushion. That should allow you to really buy, refurbish and recycle that money onto the next deal. If you do need to leave some money in, it shouldn't be the end of the world. It should hopefully give you a little bit of breathing room to do that next property still. And then obviously you've got the best case scenario column here as well, that you can also tweak these figures to see if everything went great, how that might look. Maybe in a situation where you pull all the money out, as you can see here in this best case scenario. Also, if you're investing all the money cash, you could take this column out totally and not consider the opportunity cost, put that down to 0, for example. And you can see you're only leaving £3,500 into the deal rather than the larger amount originally. Hope that makes sense. Any questions, as always, let me know. Always kind of happy to help. How this breaks down into rental yield is also important. Very often the buy, refurbish, refinance strategy, people tend to look at slightly better properties, slightly better areas. That might mean their yield is dropping compared to more mainstream buy-to-let projects. Doesn't mean it doesn't work on lower value locations. Certainly does. It can work great on straightforward mainstream buy-to-let properties. But this particular example, compared to the buy-to-let example that we used beforehand, it takes a higher value property as the use case. So that's why these figures here might look slightly different than the buy-to-let kind of returns that we were looking at on the previous sheet. Because this is a better value property, we've got a slightly higher income of about £1,000 per month. Average gross rental yield that gives us about 6.17. This is an automated column or cell, and that takes into account cell C75 and cell C68. So that is here your rental income, and that's also your total investment. So the total investment, everything it costs to buy the property, including your refurbishment, including your cost of finance. Hope that makes sense. Also then breaks down your management fees, also then breaks down your kind of not total net, because you will have extra running costs like insurance, maintenance, any void periods, things like that for running that particular property over a longer period of time, but it gives you an idea of what your gross rental income might be minus your management fees. And then you can start to assess deals on a like-for-like basis. So if you're considering one property in one part of the country or another property in another part of the country, Leeds to Leicester, for example, Newcastle to Newquay, you want to be able to assess those deals on a case-by-case basis and compare the same sort of figures across those strategies. Hope that makes sense. Any questions, let me know, and happy to help, and look forward to catching up with you next video. All the best. Take care.